Hello guys, welcome to another Lumley trading video. In this one we are going to be going through cash secure puts, how you can use them, what they are, basically what are the risks attached to them, and basically how you can get discounted shares or essentially free shares by using cash secure puts. So just before we get into the video, if you want to buy some Lumley trading merch, it's one of those first links in the descriptions. But apart from that, let's get straight into it. So again, like we talked about, it is going to be going through cash secured puts in this video. So, firstly, why do people use cash secure puts? So they're mainly used for about two main reasons. Firstly, people just like to use them to generate income. So how do you receive the income? So we'll go through this in the later slides, but with the cash secure put, you are selling a put, and as you're selling it, it means you receive that income up front. And so again, people just use that to basically generate income. Now, the main reason I personally used it and why a lot of other people use it is basically you can buy stocks you want and kind of get a lower cost basis. So basically just makes the shares more affordable. So basically you're able to buy what you want and you can kind of get paid to do it. So that is kind of the main reason people use it. Now, what other risks attached to cash secured puts? So it's basically the same as holding the shares outright. So what your max risk essentially is, and again we'll go through that example, but it's basically the cost of 100 shares minus the premium you receive. So again, here we'll go through it. So let's say you were paid $50 to sell a put at the strike of $10. So again, remember, for each put you sell, that represents 100 shares. So obviously if you sell 5 of these, yes, you would receive $250 at the strike of $10, but then you also have to buy 500 shares if it comes down to that value. But again, that's just common option knowledge. If you already knew that, again, it makes everything quite clear. So you are paid $50 to sell a put at the strike of $10. So again, what is the cost of this? The cost to buy those shares are $1,000. So that's $10 times the 100 shares you would have to buy. Obviously, if you sold 5 contracts, it would be times 500 shares. So that obviously that would cost you $5,000. But in this case, we'll just talk about one contract. So you need $1,000 collateral to basically be able to do that, because you need to be able to buy those 100 shares. So basically, your max risk is those 100 shares. So the 1,000 shares that it would cost, the $1,000 it would cost you to buy those shares, minus what you were paid to buy them. So you made $50 selling that put. So basically, your max risk is now $950. So again, it doesn't lower your risk kind of all that much by using cash secure puts. But again, you're not really looking to, or the main reason at least I use these, you don't really use them to kind of offset your risk. You're just buying at a preferred price. So, you know, if it goes to the upside, not only are you going to make more money because you're buying it at a lower price than you're currently at, but you're also getting paid to wait. So that's kind of the main reason I use them. I don't use them in the sense to kind of reduce that risk, but kind of to optimize the upside. And again, the only way you're hitting that max risk is if the underlying stock actually goes to zero. So, you know, if you're trading Tesla, the only way you can actually hit your max risk on there is obviously if it goes to zero. So quite unlikely that happens. Well, I guess it depends on the stocks you're selling. But, you know, if you're doing it on very credible names or the S&P 500 in general, you know, it's not going to go to zero. So your max risk isn't actually always going to be, you know, to zero. So what are the steps of a cash secure puts? Basically, how do you do them? First, you need to choose the underlying asset that you want to put the put option on. So we will go through an example on this, and we'll just be using the SPY. So that's the S&P 500 ETF. So whether you're a trader or an investor, again, that's something that probably appeals to you, just buying the S&P 500. So that'll be the underlying asset that we want to choose. Now, determine the strike price. So we're currently sitting at around $412 on the SPY. So we may be looking at this as a trader or an investor and thinking, okay, if SPY comes to $400 or below, that's where I want to start buying it up. So that's our strike then decided, $400. And then an expiration date, that's usually harder to say off the top of your head, because you usually want to go and look at the option chain and see kind of what offer the best bang for your buck. And then all you do once you have that strike price of the $400, again, we need that expiration date. Let's say we picked 30 days out. Then all you would need to do is sell the put option, and then you just receive your income. And then obviously you do need to set aside some cash as collateral. In most cases, most brokers will do this for you. It just won't let you trade the money that's collateralized. But if in a case your broker doesn't, just make sure you have the cash available if the stock is under that value, under your strike price coming into expiration. And then lastly, just you want to monitor your trade and manage it. Again, 9 times out of 10, you're not really going to need this because most people that sell cash secure puts, you're taking it into expiration. You want it to kind of expire. So really the only time you're ever going to want to manage it is, for example, if you were trading, say, a Meta, and your strike's at $200, it's currently sitting at $200, and then big news comes out that basically just makes the stock crash and you think it's going to continue lower, then you may just want to buy back that put if you think the underlying is going to continue, because no matter what, you're going to have to buy them at $200 if you don't close out that contract. So again, very rarely that you're really going to have to manage it. And again, you don't even really have to manage it on there. You know your risk going into it. If you were happy to buy the shares at $200, is it going to have a long fundamental change on the company? And again, that will kind of give you your answer if you need to manage it or not, or whether you want to manage it or not. So we will go on to Think or Swim now, which is just one of the main trading brokers I use, and we go through of how to do everything from the actual broker perspective, kind of make everything simple, and again, just go through everything that may be unclear. So again, we were talking about SPY is currently sitting at $412.46 at the close of Friday. So that was at the 14th of April. So again, $412. We said, what did we say? We said we want to buy it at $400 or below. So again, you've got all the option strikes here. So what are the things we could look at is we could say, okay, if we were to sell it Friday, how much would we get paid? We would get paid $25. So there it may not really be worth it. We're not making too much money. Now, let's say if we go out maybe 15 days to the 1st of May, how much do you get paid? Well, it's actually not loading, so we can't see on that one. But let's say we go out maybe 40 days, 26th of May, and then here we get paid around $400. So these are usually the ones I'll go for. The reason for that is basically look how much you're getting paid. You're getting paid $400 to sell this put, which essentially means, again, this is only going to exercise if SPY is at $400 or below. So what this basically means is we are getting paid one free share to sell this put. So if I as a trader or an investor wanted to buy SPY right now at $412, we think it's a relatively good deal, we want to buy it. We would definitely then want to buy it at $400 because it's only got cheaper. But again, we get paid to basically be patient. We get paid to wait. And if it comes down to $400, we basically just get a share for free. So that's how I look at these cash secure puts. And again, it's why I tend to do them more from an investment standpoint. I don't tend to ever do them as a trade. But definitely on the investment account, I do these quite regularly if I'm trying to buy, at least 100 shares of a stock. I very rarely now just buy them up front because again, I might as well get paid to wait a few days or weeks to buy it, and then I can buy it at a lower price than now and get paid to do that. So this is then the one we'll use for example. We're looking at a 26th of May 2023 expiry, a $400 strike. So what we'll do is we'll send this to our chart then so we can make everything clear. And there we go. So what you can see on this stock is they are still quite volatile. The options are still quite volatile intraday. We can see it went from a low of $380 to a high of $490. So that's a 28% move intraday for a stock that, for an option that doesn't expire in 40 days. So this is also key to note because if you were looking to invest in a stock or an ETF and you're trying to do this cash secure puts, you want to be paying attention to where the stock is at least intraday, because you want to be buying when it's kind of best on your side. So if SPY, for example, on this Friday opened up, shot to the upside, again, that's made those premiums go way further down because you're getting further from the likelihood of them closing in the money. Then SPY starts to kind of really reverse, starts to pull back quite heavily. And then these premiums have now gone up to $490. So now, yes, we are now closer. You can see we're about $4 or $5 closer to that expiration. But again, if we are looking to buy it at $400, it doesn't really matter if it's come a bit closer because we don't really care as much, even if the likelihood of it closing below is increased. So we might as well get paid that bit more money to wait for it to come down intraday, come down closer to that strike. And again, we can get paid for it more intraday. Again, you don't have to do this, but in some cases, I mean, that's about $110 profit you would have made just by waiting about 3 extra hours. So one of those things just to pay attention to, as it as the stock falls, the premiums will get more expensive, which if you as a seller, that's obviously going to be a big advantage. Because again, then you could also, and this is how people trade it, if it comes down and you're happy to buy it $400, you don't really care if it continues to go up because you're happy to buy it. But if it comes down, you could turn it into a trade. You could have closed this trade out, around $400, made $90 a share on that, or $90 a contract on that, just again within about 3 hours. So that's firstly kind of paying attention to the intraday part of it, trying to buy when the stocks are falling down. Now, what are the other things we should really cover? So again, we went through really how you would buy it. All you would do is just sell this. So again, you would go onto the put side, you would look at that, and you would sell. So again, making sure that you're selling it, and then you would receive $400 today. So now, what are the max risks on this? So again, we did talk about this in one of the slides, but we'll put this on here just to make it clear. So again, your max reward on the actual contract itself is that $400. We'll just put that down to 400 to make it clearer. So $400 is your absolute max reward you can get on the contract. Because again, you get paid that the day you do it. But again, that doesn't account for the upside on the share. So if this does end up filling on the other side, obviously you would make money that way. But basically, if SPY closes at $400.01 or above, that is your max reward, $400. So no matter what, you're kind of walking away with that $400 if it closes above $400. Now, if it starts to close below $400, where do you need to pay attention to? So if it closes between $400 and $396, you still make money. So between this range, even though it's below your strike, because you got paid to buy those shares, you would still be in some sort of a profit. Again, if it closes at $399, you make $300. If it goes down to $397.50, you're making about $150, and so on. Now, once we hit $396 or below, this is where you start basically losing money. So again, this is the same. If you were holding the outright shares, you would still be encountered with this loss, but your loss would have started from $400 or $412, depending on when you bought it. But in this case, your loss now doesn't start until you hit $396. So again, it kind of delays your loss by doing it through a cash secure put. Now, as the stock continues to fall, now you're basically just going to lose value as you would if you hold the 100 of the underlying shares. So if SPY goes down to $390, we can see we lost $600, considering our average would have been at $396. Again, it's basically just like owning the underlying, but again, you kind of got paid to do it. You got paid to wait. If it closes above, you still make your max profit without having to ever own the shares. And if it goes against you, you kind of offset that risk by about 1%, or in this case, by one share. But in that case, being able to reduce your average by about $4 a share isn't a bad thing. It's quite a good thing, especially if it starts to go against you. So basically, that's a risk. And again, we'll kind of zoom this out. Obviously, the risk process on this can just continue to go down. And why is that? Because again, like we said, you're buying the underlying. So you're essentially max risk if this fails. It's just whatever the shares go down to. So if the shares go down to $250, obviously in this case, you're going to be down about $15,000. But that's the same. If you bought SPY at $400, you owned 100 shares and it went down to 250, you would have lost the same, if not a tiny bit more, because again, you wouldn't have got paid that premium. So again, this is why I like it as an investment, because you're doing it on stocks that you want to buy. You've done the fundamental analysis on, you've got a long-term view on it. So they're short-term. If they start to fall, it shouldn't really matter too much. You still got paid to buy them. I don't really like doing it from a trading perspective, because again, then you still kind of have to actively manage them, when I think the strategy is a lot easier to kind of just leave it in the background, just kind of wait for you and be patient for you to buy those shares. But that's kind of the main breakdown. Again, you have all the risk of just if you own the underlying. So I think then we did cover everything. We went through how you would sell them, again, how to find the different strikes and the expiries. Again, the importance of finding the intraday move towards your strike. Again, will just really make a big boost in how much profit you can make intraday. And I think those are going to really be the key things that we need to cover on cash secure puts. It's kind of like a basic understanding of what they are, how to use them, and everything we talked about throughout the slides. So I hope you enjoyed the breakdown on those cash secure puts. If it was insightful, don't forget to drop a like and subscribe. If you thought I left anything out or you got any recommendation for future videos, let me know in the comments. And if you enjoyed this video, you'll probably enjoy this video too.